Hello everyone, in today's video I'm going to talk about how to build massive wealth in 2022 in a high inflationary environment in Canada. So why should you care? Now, if you go shopping, like grocery shopping, you probably notice that your grocery bill has been going up. Maybe you're looking for a house or you're just observing the housing market and the houses are going up and up every single year. In fact, last year it jumped up over 20%. Now, according to Canadian CPI, which is as of February 2022, the latest inflation is 5.7%. So if you are sitting on cash and doing nothing, well, you're actually losing money. Just like what Ray Dalio is saying, cash is trash. And that's why I'm so passionate to talk about today's video, which is all about helping you create multiple streams of income, build massive wealth so that you can ultimately live your best life. Now, in case you don't know me, my name is Tracy Ma. I'm a former engineer that's turned a full-time investor managing a multi-million-dollar investment portfolio in Canada and living my best life. So if you want more videos about creating multiple streams of income, building massive wealth, and ultimately living your best life, then you definitely want to hit the subscribe button and that bell notification button to get the latest and greatest videos coming to you every single week. So let's get back with the video. So the first way to profit from a high inflation environment is investing in real estate. See, real estate and rental properties in Canada have kept up with inflation over the very, very long term. In fact, over a shorter period of time, it could actually surpass inflation like it has in the last few years. So let's use an example. If you bought a home at a $500,000 K and you put in 20% down payment, which is the standard down payment to avoid having pay extra fees for insurance, then you put in 100K to buy a 500K home. So you're basically borrowing the majority of the money from a bank. Now, if the home goes up 10% a year, which is surpassing inflation because inflation's at 5.7% according to Bank of Canada, then you would have profited because your home actually went up 10%, which is 10% of 500K is 50K, and you only put in a 20% down payment. So in reality, your return on investment in just 1 year is 50K over 100K, which is 50% return on investment. Now, of course, this is looking over a very short term, a period of time. That doesn't mean that over the years you're going to continuously get 50% return on investment. It's just that in 1 year you got 50% return on investment. Of course, you need to be super careful with real estate. It's a double-edged sword because you're using leverage to compound your returns. And if you don't buy the right property in the right location, in the right neighborhood, and if you are a real estate investor like me who likes to actually rent it out, so you got to attract the right tenants, it could actually become a losing strategy. So just be sure that you use it properly. Now, the second way to profit in a high inflationary environment is owning rental properties. I know it's along the same theme as owning real estate, but in this case, you're actually renting the property out. So when you own a rental property, and as long as you buy the right property in the right location, the right neighborhood, and attract the right tenants, and of course charge the right rent, well, rental income will keep up with inflation. As long as you're able to turn over your tenants fairly frequently so that you could keep increasing the rent according to the inflationary environment or the inflationary rate. Now, also, your rental property is worth more over time because of inflation. So that means you have more and more equity building up over time. And the third awesome reason why real estate is such a great thing to own in a high inflationary environment is typically your mortgage payments can be in a fixed rate. Now, I know in Canada there's no 30-year fixed rate, but there are 5-year fixed rates, or you could choose a variable rate, which over time has always been under the fixed rate. But the point is that the mortgage payments are very low. Like we're looking at an interest rate of under 2% if it's a variable rate, or it could be 2.5% or 2.8% with a fixed rate, which is a lot less than the current inflation rate, which is the Canada CPI of 5.7%. So you see that your debt payments are low, your rental income is keeping up with inflation, your real estate is also going up with inflation, then that's a super win-win situation. This is why I'm saying it's a really awesome, profitable way to build wealth in an inflationary environment. Now, the third way to profit in a high inflationary environment is investing in dividend growth stocks. Dividend growth stocks are very boring, mature blue chip companies, and we have a lot of them in Canada, that are so boring that they don't know what to do with their cash. They are growing not that fast, but they're also really cash rich. And because they're so cash rich, they return some of that cash back to their shareholders every single year. So you invest once and you can collect a lifetime of passive income. And the key about these dividend growth companies is that they grow their dividends every single year. So it doesn't matter if the market's going down or going up or going nowhere, these companies will grow their dividends every single year to you. Now, of course, you got to be very careful when you choose dividend growth companies. You got to choose companies that will at least keep up with inflation. So if inflation is 5.7%, you got to make sure that these dividend growth companies are at least growing their dividends by 5.7% per year, if not higher. And we got a bunch of companies that you can narrow down, and I have a free resource for you and how to do all of this in my pinned comments below. Just check out the free resource, which is the Ultimate Dividend Growth Guide. But I would say I really strongly encourage you to build a bunch of assets in your stock portfolio filled with dividend growth companies. We have a bunch of them in Canada. Now, the fourth way to profit in a high inflationary environment is invest in capital compounder stocks. Now, capital compounders just basically means these companies are really good with their capital and they give you a high return on investment based on reinvesting their own cash into the company, and they get operating leverage, which basically means that whatever revenue they're growing, it also goes straight to their bottom line, which is their net income, aka their earnings. And that means the company keeps growing, 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 and making a lot of dough for a very long time. So really good capital compounders are Tesla, Amazon, Apple, et cetera, et cetera. They happen to be actually very low intensive capital companies, meaning they don't need to inject a ton of capital back into the company for them to grow. So it tends to be the tech stocks that do really, really well, and they happen to be mainly capital compounders because it doesn't take a lot of money for them to grow the revenue. Just think about it. Microsoft is a very good example. They only need to update their software, hire, more people, but they don't have to put billions of dollars into building more infrastructure so that they could sell more software products to you or to sell more of the cloud services to you. They're highly scalable. So these type of companies are very low capital intensive. So they have a high ROIC, which is in return invested capital, and with a high return invested capital with very good earnings growth rate, over the long term, these type of stocks tend to outperform the rest of the market, which is why I call them capital compounders. So when you're looking for a capital compounder, I really stress on looking at these key things, which is looking at the pricing power. Are they able to increase their prices in a high inflationary environment and people are still willing to buy them? Number two is strong brand. A strong brand typically commands high pricing power, meaning as they sell more products and they increase their prices, people don't care. They still buy their products, and there's a cult following. So strong brands tend to have a very, very loyal following that will buy their products for a very, very long time. Number three in a capital compounder is having very low capital requirements, meaning they can just put in a set amount of capital and then they can grow infinitely for a very, very long time. So Tesla is actually a really good example. I know it seems counterintuitive because you have to build the factories to build more cars, but just think about it. They only have a one-time fixed cost, which is actually building the factory. And then they have a bunch of employees there. And with time, every car that they sell is going to go straight to their profit margins over time. So you could see that it could be a fixed time, one-time cost, but over the long run, each car is going to maintain and continue to be a high profit margin for Tesla, which is called operating leverage. So you want companies like that, which I would call capital compounders, because they will outperform the market and do super well in a high inflationary environment. Now, an example of a high capital intensive company is Air Canada. So obviously Air Canada would not be capital compounder. The reason being is because they need a ton of money to buy more planes so that they could grow their company, so that they could make more income, which is not a capital compounder. So capital compounder tend to be low capital intensive companies. So for Air Canada, in order for them to grow, and make a lot of dough, they have to buy more planes. They have to hope gas prices go down, And then they have to hope that they can sell more flights. And flights is becoming a commodity. It's not like you're going to choose WestJet versus Air Canada because of customer service. You're going to choose it based on flight prices. So it's a commodity. So that's why Air Canada also doesn't have a pricing power. Okay, if the prices go up, you're probably going to stay away from Air Canada. You're going to jump ship and go onto a different airline. Now, here's 2 actionable steps that you can take right now. Now, the first one is invest in yourself. Now, if you don't have a lot of money, I would really stress is investing in yourself. That means give yourself a lot of time to learn, to read from books, to gain more skills in your career. So that may be taking up on extra projects in your career so that you can learn more and then command a higher salary. Because if you don't have a lot of money right now, the best thing you could do is actually invest in yourself, build more skills so that you could command a higher salary. Or you could do both, where you invest in your skills, in your career, and in your spare time to learn a profitable skill like investing so that you could not only command a higher salary, but take that money and then actually invest in assets that will actually make money while you're sleeping. Number 2 is please live under your means. Investing takes money. Now, I know there's a lot of videos about building passive income, and then passive has a nice ring to it, like as if you don't have to do anything and all of a sudden money appears, but that's not actually true. In fact, it's not true at all. To build assets, you need money, or you need a lot of time, which means you are actually investing in a business, which is an asset in itself. But I would say for a lot of DIY investors in Canada who are busy professionals, who have a family, who have careers, who wants to actually live life to the fullest, you don't have a lot of time where you want to build a business. So the thing I always really encourage is investing in yourself in a profitable skill and then using that to invest in assets like real estate, like stocks, like dividend growth stocks, like capital compounders that grow, and make a lot of dough in any environment. It doesn't matter if the stock market is going up, going down, or going sideways. It doesn't matter if it's a high inflationary environment. Those assets will compound massively over time so they can sleep soundly at night knowing that your assets are growing, and making a lot of dough even in a high inflationary environment. Anyways, I hope you found this video super helpful. Just as a reminder, be sure to check out in the pinned comments below a bunch of free resources to help you get started and building your assets in a high inflationary environment. Anyways, I'll see you in the next video.